if one looks at any developed fixed income market in the world, the debt, liquidity, and transparency are often linked to well-developed OTC and listed derivatives market, allowing market participants and investors to hedge their risk against foreign exchange, interest rates, or credit risk. That ultimately benefits the price discovery, but also lower the funding cost. If you talk about funding, the other cornerstone of a well-developed bond market is a well-functioning repo market, where that allows investors to basically fund their holdings, but also enabling the collateral to be reused and rehypothecated. The repo market in most of the countries are often and very often supported by a tripartite infrastructure and documented under international master agreement documentation, just like GIMRA. From a foreign exchange perspective, the level of convertibility, deliverability, transferability of the currency, and with liquidity along the term structure are equally important. So if we're looking at the China bond market, the size of it now is about, as we said earlier, is about $21 trillion US. That has grown about 80% over the past 5 years, and it's now the second largest in the world. The foreign participation to the market is mainly focused on government bonds, as we've said, and it has been certainly boosted over the past years, I said between 2019 and 2021, by the inclusion in the major bond indices. Having said that, the holdings of bonds, even if it's high in sovereign bonds, around 9%, the overall holdings from a overall bond perspective, regardless of an all type of bonds commingled, is only 3%. And the reason why is that if there's a lot of appetite to sovereign bonds from foreign investors, there's certainly hardly the case for corporate and credit bonds that foreign investors have increasingly shy away from. From an ASIFMA point of view, when we're looking at our strategy, our advocacy strategy for China, we tend to work on 4 pillars, and I know some of you have heard me quite a lot on that, so apologies for the repetition, but the first panel is really access to market. That we're focusing on the access channels, northbound, southbound, together with the operating framework. Second is the access to the products, so it's enabling international investors to access hedging and funding instruments such as government bonds, repos, or futures and interest rate swap from offshore through the various channels, but also directly from onshore. Third is the operating and the regulatory framework around these products. And if we're looking at the work that has been done around with all the market association and the enactment of the futures and derivatives law in August last year, that's typically the type of work that from an ASIFMA point of view and from an advocacy point of view we are working on. And the fourth pillar is on the credit and the corporate bond market. So the panel today will explore how financial institutions are managing their risk and liquidity in China. What are the instruments they favor? What works well? What are the impediments that they're facing? And I'm very pleased today to welcome a panel of very distinguished market experts coming from various types of institutions and business lines, so which allows us to understand the various approaches that are driving their risk and liquidity management. So we'll have Shen, who's Managing Director and Head of Global Markets China State Street, who will provide the custodian point of view. So we have John Luck from Head of Emerging Market, Greater China, Freddy, Agricole CIB, who will share his perspective as a bank. We have Freddy Wong, who's Head of head of Asia Pacific for fixed income at Invesco, and of course he will share his view from an asset management point of view. And finally, we have Robert Yu who's Managing Director and Deputy Head Fixed Income at CICC, who will do so as a broker-dealer, but also as a Chinese institution. So, and I'll start with you, Shen. So let's kickstart. So maybe with a broader perspective. So based on your business and operating model, and regardless of the market you're operating in, what are the main risks you are facing, and and amongst all the instruments that I've mentioned about futures, repos, swaps, and the like, that are available in your toolbox, which are the ones that are the most relevant when it comes down for you to manage your risk and liquidity? As I said, I mean, not especially for China, because we're going to go back to China more specifically afterwards.
Absolutely. Thanks, Philippe. And before I get started, I think I realize how, as a group of us, we realize how hard it is to be the last one before the lunch. So we'll stay short and succinct for each of us, all right? So we're in the head of a custodian bank and also coming from the FX business at global markets. So I'll probably talk about both. I think on the custody banks, our role servicing all the large institutional investors, the main role is about settlement, right? So as Philippe was introducing all the derivatives of the bond related, as a custodian bank, there's no issue on the settlement side. However, when it comes down to the tricky derivatives, the bond futures, the IRS, or even credit bonds in per se, I think the valuation is always the biggest challenge, and this is exactly where we stay very, very actively with our clients in discussion. And the second piece is about the foreign exchange business. I think from the buy side perspective, typically as a bond portfolio manager, especially the passive ones, the currency risk is the main risk that we're taking consideration to. So the currency derivatives, to take away that risk is critical. And this comes down to quite a bit of a consideration, especially when it comes down to emerging market currencies, the NDF liquidity, the maximum tenor that you can roll it into. So those are the major consideration and risk that as an institutional investor and also as a bank, we take consideration to.
John?
Yeah, so for Credit Agricole, as an international bank here in Asia, we provide, we're here to build bridges. So bridges to connect capital from onshore to offshore, from the eastern side of the world to the western side of the world, and vice versa. So for example, if a client in the US comes to us to invest in CGBs, we are here to help. If a client in China wants to invest in JGBs, we are here to help. So we build all these bridges so that our clients can easily invest, allocate the capital into more efficient channels. And also another type of business that we do is to provide the tools available for them to hedge their risks in their bond portfolio. So we are trying to have as much tools as possible, both onshore and offshore. For interest rate risk that they are facing, we have interest rate swaps, onshore and offshore, FX swaps, onshore and offshore. So all these products can help our investors hedge their risk in their bond portfolio. And we're trying to build as much as tools possible in the toolbox for our clients.
Freddy?
Yeah, I think speaking on behalf of the asset management on this panel, clearly, we've been using the bank, the broker, the custodians to really help to build our business alongside with what Philippe just mentioned among the market opening in terms of different pillars, right? But one of the key aspects that we have to think about is from a cost perspective, because we are serving the client ultimately, but also we need to balance, right? With a lot of infrastructure created, how would we create the most cost-efficient business model to service them most efficiently? And I would say the beauty is that being a global firm, that we serve clients globally, whether it's in the US, in Europe, or here in Asia. One of the benefits that as a firm ourselves getting is also have a good perspective around China, because we run a big operations as part of our Invesco Great Wall as a mutual funds that's been very successful domestically. And you can look across like different client asks within that respective times to really map into all the need for them to really functions, if you will. And I would say those 4 pillars that Philippe mentioned is critical for us to think for more medium long term, because we've been in the industry long enough to witness the China opening. I would say if you look back decades ago, it was completely a different story when we will have difficulties to find the right channel to get to. But now we're in a different stage to really give us a lot of different ways to get to the China. But which one is the most efficient? Which one would allow you to tell your client that maybe client demand for instant data with all the AI support, right? These are the critical paths that we have to think carefully to really on a cost-aware perspective to serve the client going forward. So I think this is all the advocacy that we are trying to build together, and especially that I saw there's a white paper on China capital markets just published, and I'm not speaking on behalf of ASIFMA, but if you are willing to spend a day to read that, because it's 200 plus pages, that will give you a lot of intel within there. And I would say this almost serves as a Bible for people who want to know a little bit more about China. So I find it quite useful to really help also our clients to do stuff as they wanted. But yeah.
Thank you.
I'm not trying to help.
No. I'll go back on that later on, but thank you for hinting to that. Robert.
Yeah, thanks. At CICC, we are really just a platform. We offer our clients with trading ideas. Our business model is similar to John's. We're market makers, and we offer structuring capabilities as well as risk management tools for both onshore and offshore clients, as well as the cross-border needs. For us, obviously, our clients pay close attention to credit risks and liquidity risk. Every day, we as broker-dealer, we borrow, and we try to borrow the cheapest funding as possible. And there's always mismatch, and that's how you to do hedging. And then the tools and products allow us to hedge perfectly or as close to perfect as possible is very important. And also the volatilities for, say, commodities is also important because we help our clients to trade or access commodity markets across the world. And last year, obviously, when energy prices and some special metals are swinging wildly, and half the world away from our markets and in the middle of nights. And those are the things that our clients are concerned most, and we pay a close attention to as well.
Thank you, all of you. So let's deep dive now on China, which is basically the purpose of the conference and the panel. So when you're looking at managing the risk and liquidity of your China portfolio and activities, what are the instruments that you would be looking at? What are the specifics you're going to want to have to deal with? And to that extent, what works well currently when doing that for China, and what probably needs to be a bit of improvement, or what are the impediments that you're facing there? So maybe, may I stay with you,
Sure.
Robert, and then we're going the whole way around.
Yeah, I would say probably one of the most important aspect is the hedging of the interest rate swings. As you mentioned, China's markets is probably second largest. By RMB term is close to 150 trillion in RMB, and second largest. If you notice, a majority of the products or bonds are fixed rates. But for institutions like us and many our clients, they borrow at a floating rate, for example, 7-day repo. So managing that interest rate basis is very important. And obviously, the China market itself is deep, and the products we do offer the lowest volatility and also high correlations with the underlying securities. So that's certainly a very important tool for us.
Maybe from your perspective,
yeah,
Freddy?
I think a lot of clients that we talk to globally, right? Even until this stage, when you have that China conversation with them, they would typically talk about, okay, the China government bond yield at what level, and that stopped. they won't go drill further down to, okay, what else are there on offer, right? But obviously, the infrastructure now is allowing us to do a lot more. So typically, when you construct a portfolio, right, big part of that will be a credit risk. And then you add a lot of interest rate sensitivities plus your currency risk on top. And you do have the infrastructure supporting all this implementation within your portfolios. But the way that you look at it sitting in offshore market versus domestic market, the way to really implement those strategies into the portfolio will be quite different, as we are still talking about how to assess what channel to get into the domestic market, right? Are you in the same level playing field versus those guys sitting in domestic market that they can just directly deal with on a day-to-day basis? So this would clearly, with all the Connect program that we established here in Hong Kong, will facilitate those flow. But in the end of the day, I would say liquidity is still boiled down into a very important factor when a lot of people think about to build a portfolio. And they still believe that China government bonds offer you some sort of good liquidity, despite the fact that we still have some infrastructure to build in the future. And reality, in my mind, actually is slightly different because people just don't get familiarized with some of the other instruments that are available domestically. And I think that's really requires some sort of further educations. And people got more like with this like push or pull factor. And typically, when you look back 2017, because of the global index inclusion having China there, so people get pulled into that game to really start thinking around how to construct that portfolio. But what if the corporate bond markets could become part of that earlier? And I think those investors will have no choice almost. They think about, okay, what should I position in those areas and how to hedge those, etc. And that will create a slightly different value propositions for us to talk about when the single-digit number, which you mentioned earlier, will become much larger. And I would say that was very much things that we still need to look forward.
Yeah. There's a few points on which I'll come back later, but leave it to John now.
Yeah. So we've been talking to a lot of clients, and from what we see, different clients have different preferences in terms of the way they access the China bond market. There are some type of clients that they prefer the onshore access way, which is the CIBM Direct. And there's also the offshore way, which is the Bond Connect way. These two different ways have different type of hedging instruments that they can use to hedge their risk and liquidity. Let me start with the onshore way first. The CIBM Direct way, they can access to all the onshore derivatives available, like the IRS, FX swap, and for government type of institutions, even a bond repo. But for these onshore derivatives, before them, there are several challenges that they need to face. For example, there is the documentation challenge, which is in onshore, they use the NAFME documentation, which they are not very used to. They're used to the ESTA documentation internationally. And they also, because China is not a non-netting jurisdiction before, and however, last year in August, China passed the Futures and Derivatives Law. And much of these challenges are solved all at once. So, I mean, this law basically recognizes the enforceability of close-out netting. And this thing reduces the counterparty risk greatly for institutions to involve in derivative transactions. So the capacity to hedge their bond portfolio by derivatives greatly increased. And then this law also recognizes international master agreements like the ESTA that and international managers, bond funds are very used to. So they have greater confidence to involve in derivative transactions to hedge their risks. So this is the onshore part. And then for the offshore part, for Bond Connect clients, initially there's only a limited number of tools that they can use to hedge their risks. And then, but as time goes by, more and more products are available. So for example, last month, there's the Swap Connect. The Swap Connect was launched. Before that, these offshore investors can only use NDIRS to hedge their interest rate risk, which is very popular among them. I mean, but then the liquidity is not as good as onshore, and then they need to sit on the basis risk between onshore and offshore. So this swap connect come out, and basically these offshore investors can use onshore IRS to hedge their interest rate exposure for their bond portfolio, which is much more effective. The liquidity is much better and deeper, and solve much of the basis problem that they're facing. So all in all, we see that the challenges offshore investors are facing are being addressed one by one, and which makes the China bond investment much more attractive over time.
Thank you, John. Maybe Shen, from your perspective?
Yeah, I think just piggyback on what John just mentioned about the interest rate liquidity. I think I'm going to speak about the FX liquidity, and this is going back to earlier session about the communication, about the training to all the investors. China is different, complicated in the sense that in terms of currencies, you have the choice between, say, CNH, offshore, onshore CNY. In the hedging world, you even get to choose the NDF. I think there's no right or wrong among all the three choices here. To start with, I think the liquidity hours are different. Being CNY, stick to the onshore hour. And if you just focus on the onshore hour, I think CNY definitely surpassed the other two in terms of the liquidity offering, market depths, trading volume, et cetera, et cetera. However, CNH and NDF of the CNY stays the 24-hour. For some of the U.S. investors or London investors, if they want to focus on, say, outside of the Asia hours, those are the choices that people would have. I think at the end of the day, as a liquidity service provider, we just need to constantly communicate to our clients, keep everybody updated about the liquidity situation, and what is the best tools for our clients to choose and utilize. And circling back to what Freddy mentioned about the infrastructure, put on the custodian hat, I think infrastructure is quite critical, and especially in the context of a China bond, where you can trade CNH and CNY denominated bonds, and quite frankly, I understand there are a lot of regulators here. I'm not trying to butter you up, but you did react very, very fast. Thanks to Hong Kong MA, issue a lot of prescriptive rules on the monitoring side. This is 115% for idle cash, for over-hedging. But it does require the industry players to be innovative as well. So from State Street perspective, to distinguish the two currencies, especially on the security side, you can utilize the settlement location to tell the difference, and more importantly, you can set up the different currency denominated account to tell the difference. I think the operational efficiency, the robustness, plus better liquidity, as we all see over the past 4 or 5 years, helps the China market build up the credibility.
Thank you all. Going back on, just staying on the liquidity, and we mentioned earlier the futures and derivatives law, and I remember when we were responding to the various consultation on that front, we were trying to squeeze the repo in the scope of a product for the futures and derivatives, because we knew at the time that it would be a very important milestone in the regulatory framework for China and for the international investors. Unfortunately, and probably logically, the repo were not included. So what we are advocating now is for the GMRA and the repos to be covered by a set of regulations that are similar than the one that would be covered the futures and the derivatives. So that's what we have been advocating and been engaging with the regulators on the recognition of GMRA under the November 2021 CBRC, which is now an FRA notice, and the recognition, therefore, of the GMRA as a relevant master agreement under the proposed CBRC, NFRA, and PBOC capital rules. Because at the end of the day, going back to what you guys were mentioning around the hedging, you want to make sure as well that the instruments that the foreign investor can access to are there, are deep, are liquid. But the same thing is we believe also for all the liquidity instruments and the funding instruments. But then going back to what was mentioned earlier, do you think that there's a proper level playing field today when accessing the funding instruments. I know that we've talked about, we can come back on the hedging instrument afterwards, but maybe staying with you, Shen, on the liquidity side. Do you think that there's a level playing field between international investors and domestic investors in China when accessing tools for and instruments for their funding?
Absolutely. I think repo, as you rightly called out, is quite critical. As a financial service company, we service our clients. We keep hearing this story with advocacy from our client base as well coming through. When does Bond Connect support repo? Even though for the CIBM Direct, as John was mentioning, the central bank type, or we call it OPB, the offshore participating bank, has the access. But I guess majority of the investors at the moment doesn't really have full access to that as well. And putting things in context is a very, very critical funding approach. And then we understand this Swap Connect is really welcome to see that being launched. But one of the big live scenario people use IRS is really to lock in the funding rate, right? So you need a repo to facilitate it, more coming hand in hand together with the IRS. But based on the trend we're seeing here, 5 years ago we were saying bond access to China is impossible. Now it's possible. Swap Connect 5 years later got launched. IRS is possible. I can only stay positive for the repo story to play out.
Anybody else on the liquidity side?
Yeah, same. I mean, over the past few years, more and more products are available for liquidity for offshore investors. And nowadays they can use onshore and offshore FX swaps for their funding. But then in the conversation with our clients, we see that a lot of them would prefer to have a bond repo market as well for liquidity. Because for a lot of international bond markets, like the US Treasury market, EGBs, JGBs, all of them have a very deep and liquid bond repo market for them to fund their bond portfolio. And that's definitely a very useful tool to have, on the wish list of most of our clients.
Yeah, we've been floating, I know, with both with the HKMA and with Reagan in China, a kind of a repo connect scheme where basically you could access the repo market through a connect framework here, which at the end of the day would not be completely, which would be a good idea. The other part as well in terms of liquidity is to be able to leverage the collateral, the holdings here and the Bond Connect as collateral. Could it be for margining and the Swap Connect or for any other type of financing, either offshore or onshore? But if you're looking at going back quickly on Robert, anything else from your end on the liquidity?
Echo Shen and John's. I think it's very important for people to have that choice. Obviously, some of the largest like central banks or monetary authorities already have that capabilities, but not for Bond Connect. But for some investors who rely on borrowing facilities, obviously borrowing cost is very important for them. So I think that definitely can add more activities to the bond markets with that repo. But again, I think things need to take step by step, and I'm hopeful that eventually, that will be available for most investors.
Yeah. And indeed, from the conversation we've had with both the regulator here in Hong Kong, but also on the other side of the border, clearly repo has now become at the forefront of the conversation. And when we met the regulators, it was clearly something that they were open to discuss, which is, I think, reassuring to that extent. Just want to get back, with you, Freddy, on the hedging tools. And I know that from the very discussion, I know that from my colleague Eugenie, who runs the asset management. I know that when we're coming down to hedging tools, Swap Connect was a nice to have for the asset managers, but clearly the futures would have definitely be a much more powerful tool. Maybe can you just give us probably a bit of your perspective from that on that front, why futures would be your preferred instrument and why reaching and accessing the onshore liquidity would be critical?
Yeah, I think first of all, the transparency of future market in anywhere in the world, very deep market. If you use European market, you don't worry about liquidity in any future market. And China will be the same if you look at the domestic future market. It's been extensively used across different part of the curve. I think we have a lot of smart people here, and we just have to really think collectively the way how we create a pool of liquidity together, because we are talking about a lot of like onshore, offshore, right? And in the end of the day, it's still everything CNY denominated. But the thing is, liquidity is aggregate into one single pool of asset, if you look at that way, and whether that's onshore and offshore concept has to stay perpetually, or there's some way that we can think of we are addressing or we are assessing the same pool of liquidity, whether you're sitting in Hong Kong, you're sitting in New York, or sitting just domestically in China. I think this is some work that we all need to think carefully. And still, people talk about CNH and CNY. And I can give you one simple analogy is that these two, to some extent, are different, but actually they are the same. And I believe that some of you are using WeChat, or many of you. And sometimes you get a web packet from someone sitting in Shanghai, and you just grab it. But you may be in Hong Kong, or you may still be in Shanghai. But how do you define that CNY when someone in Shanghai gives you the money and you put it in Hong Kong? Versus you do it in Hong Kong and someone in China. So do you define that as CNH or CNY, or just one currency? So we just have to think about how that pool of liquidities are being defined. And similar to your questions on the future, right? The danger will be like we create a separate pool of liquidity when everyone's just sitting somewhere outside of China to access that small pool of future market. That will create some problems that people will encounter like any other market. But if we are equally access to the domestic market, when you put all the collaterals, your cheapest to deliver kind of mechanisms are well in place. I think that is like the ideal world that whatever efficient portfolio that we want to implement to really cover that duration aspect is very well in place. And I think this will continue to be a big ask from the industry advocacy to really hope that will sort of give a level playing field across.
But talking about the fragmentation of the liquidity, I think one of the key asks, and that's how the structure of many developed markets have been built, having a tri-party solutions onshore in a particular market connected to collateral managers or international tripartite providers outside of a particular country and linking that together. That's how you really bring these pools of liquidity together. Is it something that, from your perspective, being able to move somehow your assets from onshore to offshore to offshore from offshore will definitely bring value and liquidity to the market and will serve your need? Maybe going back to you, Shen, from your perspective.
I think I can very well talk about the currency market in this specific case. I think, back to our topics, is the liquidity pool converging? I think I can safely say, if you got long teeth like me in the NDF market, you can tell probably 15 years ago, 20 years ago, the CNY, NDO, NDF liquidity is really, really poor. Over the years, it developed itself, but now that CNY onshore deliverable started coming up, we can see, it's going back again. You can see the NDF CNY in Hong Kong hours just deteriorate quickly. So the market will have its own wisdom to constantly develop itself. Circling back about the CNY, CNH, back to Freddy's points, at the end of the day, it's money, it's renminbi. So from that angle, it's all converging. But I treat it as more part of this renminbi internationalization. At the starting stage, probably monitoring is still prevailing for the sense that China is still being considered as an emerging market. So there's a lot of additional measures to being taken place. Having said that, I think over the years you can see the regulations started freeing up. We talk about the repatriation cap once you engage the CIBM Direct for the dual currency funding. Now on the renminbi side, it's already lifted. So maybe in 2 or 3 years' time, the other side will be further relaxed. So then naturally everything just merged together for one big liquidity pool.
Robert, anything from your perspective on that, or anything to add?
Well, not specific to that, but I think I know that's some proposal. ASIFMA has been talking to regulators, but I think For example, the Swap Connect. I mean, there's no solution, and then you have to give credit to both regulators on both sides, and they come up with this innovative arrangement where you have two clearinghouses and set up this intro CCP margin so that they allow the different pockets of investors who have different trading practices or settlement practices to, without changing much of their habit, and to deal with that and then minimize risk, and then allow the access. It's a very important step. I mean, I'm sure there's more step coming up to bring more products and to bring more access. So I think to that, I think it could equally be applied to your tri-party solutions. It might need some tweaks or changes, but I think that's again that's another way that Hong Kong can play a great bridging function in terms of bringing more investors with different trading habits and without the settlement hassles to get access to the different market.
I think that was a very fair point. I have to say that Swap Connect, the way it has been structured, and the need of collaboration and coordination between regulation and alignment of regulatory framework between the two jurisdictions, and making sure that you can trade seamlessly swaps on both sides of the border under the same mechanism. I think it's absolutely critical, and that has been quite an achievement, because it looks simple, but clearly from a practical point of view, from a regulatory point of view, from a risk management point of view, it's definitely something that has to be, that we have to give credit to the regulators and to the market infrastructure for having achieved that. Of course, the way was already set with Stock Connect, Bond Connect, and the like, but I think that it's probably an additional level of complexity. I know that we're reaching the end of our panel, so we have probably another 5 minutes, because we started 5 minutes later than that. So
You're breaking my promise.
Yeah, exactly. So maybe just to conclude, if you would have one ask, and the reason why I'm asking that is that, as you know, and because you were referring, Freddy, you were referring to the China white paper, and yes, indeed, it's big stuff. I mean, it's about 100 and close to 200 pages, 150 recommendations. So it's a fantastic work that both from an industry and from all the law firms who have helped us to get that. But it's both an information pack, put it that way, but also it's an advocacy. So it's basically it's the summary. But 150 is quite a bit of a summary, but anyway. So it's a summary of our key ask and recommendation to the regulators across all spectrum and all the topics that we will be discussing today, not only in this panel. So for us, it is important to gather the feedback from the industry, because at the end of the day, we are the voice of the industry when we're going to the regulator. And I know a number of you in the room here who are participating all our committees and working group are providing this input. So I just want to, so that was a long intro for the last question. I'm sorry for that. Maybe each of you, what would be your ask, something that you would like us to bring into our advocacy list? Maybe Shen coming out and going this way.
Absolutely. I think if anything, I'm going to ask you, with the regulators here, I'm going to ask you for the regulatory, consistency. We have so many approved channels to China, the Stock Connect, the QFII, the Bond Connect, the CIBM. But unfortunately, some of those regulations around each of the schemes are a little bit uneven. Giving you an example, the QFII at this moment doesn't really allow third-party FX, while CIBM and Bond Connect allows for third-party FX. And to add in a bit of a complexity, for the CIBM, and if you break down the settlement side for the bond, is a little bit number of the liquidity provider that you can adopt, but for the hedging side, it's only 3. So there are too many numbers, I think, as investors to remember. I think if a consistent regulation across all the channels, that would be much appreciated.
Thank you, Shen.
Yeah, so I think it's hard to pinpoint one specific key ask. I think it's the overall direction. I mean, over the past 10 years, we have seen China opening up the renminbi internationalization. I mean, step by step, the renminbi open up to foreign investors. I think we just need to keep up with this pace. I mean, keep up with the pace of renminbi internationalization, so that it's easier for international investors to invest in the China market. And we just hope that this pace will continue to go on in the coming years.
Thanks.
Yeah, I would say for me, we already have like 150 plus asks in the advocacy paper, and hard to add another one. But I would say just more looking for what I see in terms of the global landscape, right? On one hand, global investors are meaningfully under-allocated to China. On the other hand, China's investors are very struggle to invest globally, to find a way that they can invest global. And this gives you a lot of wiggle room to really think of what to build to help neutralize this. But of course, underneath, right, there are a lot of language barrier that people get access to China. It's still remain top of the list that people need to figure out. You don't want to just put local experts to tell you secondhand information next day that this is how China works. You want that to be doing that, seeing and believing that kind of theory, that you will be able to be the persons to really navigate the game plan in China. But as I highlight, it's very obvious that both sides have to do some work.
Yeah, you're right. Robert, from your perspective.
Well, yeah, from market making perspective, we obviously want to see more access both ways for investors, both onshore and offshores. And the bigger the market, the more the participants, the better. And obviously, you know, with the many connects we just mentioned, we still have some connects we need to, for example, the other side. For example, we had Bond Connect North and now Bond Connect South, and we have Swap Connect North, and then looking forward to you know, someday you know, Swap Connect Southbound as well, and also add more products to the existing Connect. You know, for example, again, we just mentioned the repo on the existing connects, and as well as in addition to the 3 types of you know, interest rate hedging tools products, so we can add more to the, you know, the Swap Connect, and those things will definitely help with the activities and bring more investors to the markets. I mean, market interest rate or market situation change. You know, we have experienced many years of higher China interest rate versus the rest of the world. Now, and but you know, that's the beauty of the you know, the market. So you always have something to do, and you know, you don't get too boring. So pretty hopeful that will happen.
Thank you very much, all of you. I mean, I feel that you've summarized pretty well the themes of our key ask in the paper. Is basically the keeping the change in a consistent way, balancing the outflows and the outbound and the outbound communication, absolutely key, and more access to the market, more access to the product. I think that summarizes it well. Thank you very much